What's up, future millionaires? Ever heard the saying, be greedy when others are fearful? Well, guess what? It's not just a cute quote for your vision board. It's practically the secret handshake of the super rich. And right now, folks, the stock market is doing its best impression of a toddler throwing a tantrum. But for us, that's not a crisis. It's an opportunity with a capital O. So, if you're ready to turn market mayhem into massive moolah, stick around. Because in this video, I'm cracking open the vault on why the market's acting cuckoo, how far it could fall. Don't worry, it's not the end of the world, just a really good sale. How to be greedy like a pro, and of course, the stocks I'm eyeing like a hawk if prices keep plummeting. Your time is more valuable than my questionable fashion sense, so let's dive in. Data versus feelings. First things first, and this is crucial, we're making moves based on cold, hard data, not your Uncle Barry's gut feeling after 3 coffees and a dream. I know it's hard not to panic when the financial news channels are screaming like a banshee at a full moon. That's why I'm here. I'm your financial Zen master guiding you through the chaos. And hey, I'm not here to hold you hostage. Here's your sneak peek at today's roadmap. What just made the market go boom? And why? How far this roller coaster could actually drop and for how long? The secret sauce to being greedy when everyone else is hiding under their bed. And my personal shopping list of stocks if prices keep tanking. Ready? Let's get into the nitty-gritty of this latest market meltdown. So, what just sent markets worldwide into a full-blown existential crisis? Drumroll, please. Tariffs. Specifically, President Trump threatened a new supersized round of tariffs on China. We're talking about a 100% tariff on goods imported from China on top of what they're already paying. And get this, it was effective November 1st, just 19 days. Talk about a ticking time bomb. Chinese product trying to enter the U.S., then hitting a giant 100% tariff wall and bouncing back. This wasn't just a random act of economic aggression, it's a direct response to China announcing expanded export controls on rare earth elements. Think of rare earth elements as the secret sauce for pretty much everything modern: AI chips, electric vehicle batteries, jet engines, defense systems. Basically, if it's shiny and smart, it probably needs these. China currently controls about 70% of the world's rare earth supply and over 90% of the processed rare earth materials and magnets. That's like them owning the only candy store in town and then saying, nope, no more lollipops for you. This means almost every chip maker and AI hardware company could be facing some serious supply chain shenanigans. And it's not just physical goods. Trump's new controls also include AI and semiconductor-related software. So VO AI companies are getting hit from both sides, like a financial double tap. Now you might be thinking, didn't this trade war thing happen back in April? Didn't the market just shrug it off? Good memory, Sherlock. Tariffs peaked at a whopping 145% back then, but they quickly dropped to 10 to 30% after both sides agreed to a 90-day, let's all calm down, pause. The market rebounded and we made money being greedy when others were being fearful. But this time, my friends, it's different. Like, this isn't just a phase, Mom, different. These escalations have a much higher starting tariff rate, a full 100% on top of existing tariffs, not just resuming old ones. Plus, it's broader: goods, critical materials, port fees, and tech exports. It's like they upgraded from a water pistol to a super soaker. There's also a big shift in tone. President Trump is hinting that high-level negotiations might not even happen. This suggests both sides are willing to endure much more economic pain than before. Translation: these tariffs and restrictions could stick around longer than a bad dad joke at Thanksgiving. In fact, a study by the National Bureau of Economic Research found that Trump's 2018 trade war costs were passed entirely onto importers and consumers, and the Federal Reserve chimed in, saying those tariffs led to increased job losses and higher prices. Higher unemployment and higher prices mean less spending, less profit for companies, and ultimately, lower stock prices. That's the tragicomic connection between tariffs and your portfolio taking a hit right now. Tariffs equal higher costs equal less spending equal lower profits equal lower stock prices. So the big question, how far could stocks actually fall? And should we be panicking and stocking up on canned goods and crypto? Just kidding, mostly. We don't want to rely on emotions, so let's look at some historic market data. Let's get back to the good stuff, seeing how far stocks could actually fall by looking at data from previous market crashes. Those are recessions. Spoiler alert, bull markets are like that friend who always brings the good snacks. They last around 4.3 years and return an average of 150%. That's about a 24% compound annual growth rate. Not too shabby. On the flip side, bear markets are like that friend who only ever wants to talk about their problems. They only last about 11 months on average and draw down by about 32%. So while bear markets are steeper, bull markets last over 300% longer, recovering all those losses and then some. This is why millionaires are made when the stock market drops. They become massive windows of opportunity to buy great stocks at deep discounts. It's like finding a Ferrari for the price of a tricycle. This is also why my channel focuses on long-term investing. It takes years for markets to hit the top and recover from their bottom. Patience, young investopians. Here's another study that splits bear markets into their declines versus their recoveries. For example, in 1956, the S&P 500 dropped by 21.6% over 15 months and then took another 11 months to recover. But look at the pandemic crash. The S&P 500 plummeted 34% in a single month and only took 5 months to recover. Wild, right? Two big insights from this study that will help make you a millionaire. Looking at data from previous crashes isn't the same as actually living through one. Most of us would probably say we'd rather take the 2020 crash over 1956 because it was so much faster. But in reality, the 2020 crash was brutal. It averaged almost a 2% decline per trading day for a month straight. Imagine waking up every day for a month and seeing your portfolio shrink like a sweater in the dryer. Even though the shortest bear markets cram all that panic selling into a few weeks, the average bear market actually takes about a year to bottom and about 2 years to fully recover. Not weeks, but years. That's why it's so important to keep some cash on the side and to dollar cost average in over time. Don't go all in like you're playing poker in Vegas. Play it smart. All right, so far we've covered what's causing this latest market dip, and we've looked at some important historical data to see how far stocks could fall and for how long. But how do we know when to be fearful and when to be greedy? Is there a secret signal? A bat signal for investors? Guess what? The answer is more data. What I love about this index is that it's calculated from 7 different market indicators. We're talking stock price momentum, strength and breadth, the ratio of puts to call options, market volatility, and demand for stocks versus bonds. It's like the Avengers of market indicators, all teaming up to tell you what's up. Out of the 7, I pay closest attention to market momentum and volatility. I like to dollar cost average into my favorite stocks even more aggressively when market momentum dips below the 125-day moving average. That's about 6 months of trading days. As you can see, we're not quite there yet. But look what happened back in April. Market momentum was well below its 6-month average from March 13th all the way to May 7th. That was a golden window to buy stocks, and momentum bottomed out on April 8th. The exact same day the S&P 500 bottomed. Coincidence? I think not. I also like to buy when the VX, which measures the S&P 500's volatility, act of the fear gauge, spikes to around 30 or higher. Again, hasn't happened yet. But if we rewind to April, the VIX topped out on April 8th. Again, the exact bottom for the S&P 500. That's why I made so many videos in April covering those tariffs when this index was screaming extreme fear. This is a powerful tool for knowing when to channel your inner Scrooge McDuck and go shopping. Personally, right now isn't the time for me to be super greedy just yet. I'm waiting for the VIX to get closer to 30, and I'm waiting for market momentum to drop below its 6-month average first. Patience, my friends, patience. All right, now that we have all that juicy context, we can finally talk about which stocks to buy when the time is right. And if you feel I've earned it, consider hitting that like button and subscribing to the channel. It really helps me out and lets me know to keep making more content like this. Thanks. And with that out of the way, let's talk some stocks. Like I've been saying all year, the foundation of every good long-term portfolio starts with a fund. Especially if you're a newer or more emotional investor with itchy fingers. You know who you are. We've all been there. All the data we've looked at tracks the S&P 500, but it applies just as much to the NASDAQ 100 since they have so many holdings in common and tend to move together like a financial synchronized swimming team. The NASDAQ has a few advantages over the S&P, like not being limited to U.S. companies and not holding commercial or investment banks. And since it only holds 100 companies compared to the S&P's 500, the NASDAQ tends to make higher highs in bull markets and lower lows in bear markets. Exactly what I want when I'm being greedy. It's like getting a bigger discount on an already great sale. And if you're in the U.S., check out VGT, Vanguard's Information Technology ETF. VGT holds more companies for diversification, lets their winners ride for longer for performance, and has lower fees than the NASDAQ. As a result, it tends to make slightly higher highs and lower lows with a lower cost. But just to be clear, both of these funds are fantastic foundations for any long-term portfolio. When it comes to individual stocks, I'm looking for two things. First, I want them to be affected by these latest tariff announcements. Because honestly, I don't think another 100% tariff on China will last for very long. Second, I want them to be core holdings for the AI era. That way, even if I'm wrong about the tariff timeline, they're all stocks I'm comfortable holding for the long term. It's like buying a timeless classic, not a fleeting fad. First up, CoreWeave. CoreWeave is an AI-focused cloud computing company that provides the infrastructure for AI workloads. Think GPU clusters, high-performance storage, and high-bandwidth networking. These guys don't just get priority access to NVIDIA's latest GPUs, they're also one of NVIDIA's biggest investments. That's like getting the secret recipe directly from the master chef. That's why I'm comfortable holding this stock for years and years. Discounted cash flow models show CoreWeave as 33% undervalued today. In other words, CoreWeave stock would have to go up by 50% just to hit its fair value. That's a 50% upside on a company sitting at the absolute heart of the AI revolution. Like I said at the start, millionaires are made when the stock market crashes. Now you see why. The next company I'm watching like a hawk is Amazon. There's no doubt an additional 100% tariff on Chinese goods is going to affect their massive e-commerce business. And the same is true on the AI chip and software side for Amazon Web Services, AWS. Amazon currently trades at a price-to-earnings ratio of 33, which is below its average for the last 2 years. And according to DCF models, Amazon is currently 20% undervalued, meaning it already has a 25% upside from today's prices. But I think that's a conservative estimate because analysts and models tend to undervalue the explosive growth of Amazon Web Services and Amazon's advertising business. Most investors still don't realize that Amazon is the fourth fastest growing advertising company on the planet, only behind Mercado Libre, Reddit, and TikTok. And that's on top of their massive e-commerce and cloud service businesses. It's also the third largest advertising company overall, only behind Google and Meta Platforms. Talk about a hidden gem. Speaking of which, Meta Platforms is currently 36% undervalued, giving it a whopping 56% upside from today's prices. Talk about an obvious slam-dunk investment for the AI era. It's like finding a winning lottery ticket just lying on the street. So hopefully, this video helped you understand what's causing the latest market downturn, how bear markets compare to bull markets, exactly what data to use to be greedy when others are being fearful, and of course, some great stocks to watch for when it's actually time to pull the trigger. Because relying on data instead of emotions is the best way to get rich without getting lucky. And if you want to see what else I'm buying to get rich without getting lucky, check out this video next. Either way, thanks for watching, and until next time, this is Wealth Investopia, reminding you that the best investment you can make is in you.